So I know a lot of people, including myself, are interested in investing in some high dividend paying stocks. I mean, who wouldn't want a piece of the pie of a company's earnings, of course? However, before buying these stocks, there are many things we must analyze to make sure that the dividend paying stock we're buying is the proper stock to buy, and that it's going to give us the results that we want to see out of it, whether it be over the short term or the long term. However, before buying one of those stocks, we're going to have to see if the dividend paying stock is the correct one for us and meets our goals and expected returns in the long term. To help with that, today I'm going to show and explain 6 different metrics that hopefully help guide you through the process of picking the proper dividend paying stocks for yourself. Some of these metrics are pretty well known and widely used, others are not so much, so hopefully everyone can learn a little bit out of this video. If you're interested in investing in stocks, you can open an account with Webull, and once you deposit $100 or more, you can get 2 free stocks that are valued up to $1,400, and you can do so with the link down in the description. Now let's go on with the rest of the video. The first metric I want to talk about here is about the payout ratio. I cannot stress enough how important it is to look at the payout ratio before you invest in a dividend stock. You can calculate the payout ratio by getting the total amount of dividends paid divided by the total net income of the company. What the payout ratio is telling us is what percentage of a company's earnings is paid out as dividends. It's likely that someday you'll encounter a company that pays very high dividends but also has a payout ratio of over 100%, which means that they're actually paying more than their total net income as dividends. And that means that eventually a dividend reduction or cut could be even more likely. Companies with a relatively low payout ratio can show us that there is room to grow for the dividends and that they're not spending all of their net income on giving dividends to shareholders. This is a good thing. We want companies to stay profitable and not be spending all of their earnings immediately. The payout ratio is usually easily available on tools such as Yahoo Finance, so don't worry about crunching the numbers yourself all the time. Also note that whenever dividends increase or decrease, the payout ratio is also going to increase or decrease, so it's good to stay updated with that metric every so often. Another important and lesser known metric is that of the dividend coverage ratio. The dividend coverage ratio basically tells us how many times a company can pay its dividend to its shareholders. The formula to get the dividend coverage ratio is very simple. You just have to get the net profit and divide it by the total dividend paid. So if a company's net earnings over a certain time period were $15,000 and the dividend that they paid out to shareholders was $5,000, then their dividend coverage ratio would be 3. While a low payout ratio is better, we want a higher coverage ratio. In general, a coverage ratio of 2 or above is considered safe. A high coverage ratio simply means that once dividends are paid, a company can do whatever else they want with their remaining profits. It also means that in the case of a downturn, they may be able to pay their shareholders dividends anyways, at least temporarily. Once we see a lower or even a negative cover ratio, we know a company can be in trouble and either a dividend cut or reduction is on the way. The third metric we want to look at is that of the dividend growth rate. It basically tells us what rate has the dividend been growing at per year on average. There may be stocks that have a lower dividend on paper but actually have a really good growth rate or a consistent growth rate, and that means that while the dividend is on paper fairly low right now, eventually it may grow into a fairly substantial dividend and could prove a pretty good investment. We do want to make sure, however, that there are multiple data points for the dividend growth rate. If a company just announced dividends and maybe doubled them in their second quarter, then we're going to have an unrealistically high dividend growth rate. So you want to see that this company has a large track record of dividends that spans multiple years, and that way we can get a consistent average number of dividend growth. While this is never a guarantee, a strong track record of dividend growth over the years can tell us that a company is confident in its long-term profitability and will probably keep increasing those dividend payouts over the years. This leads me to my next point. We want to see exactly how many years has a stock paid dividends and how many years has this dividend grown. For example, you may have heard of the Dividend Aristocrats. These are the 25 stocks in the S&P 500 that have been growing their dividend payouts for 25 years or more. This track record that the Dividend Aristocrats, among other stocks, have gives confidence to many investors and would make people more likely to invest in them in the future. But there's quite a few companies outside of the S&P 500 as well that have been paying dividends and increasing their dividend payouts for an important amount of years. You can look at these track records through a simple Google search, or if you want a more visual version of it, Dividend.com includes histograms for many of the stocks it supports. Another very important metric that a lot of people don't take into account is that called free cash flow to equity. This metric tells us the amount of cash that a business generates that is available to potentially redistribute to its shareholders. The formula is basically an assets minus liabilities formula. You basically just get the net income and subtract the net expenditures or any other sort of liabilities that the company currently has, and then you add the net debts, and then you'll get the total amount that the company has that they could potentially redistribute to their shareholders. Lastly, I want to talk about the dividend yield. We would all like a very high dividend yield, but we need to combine the information of the dividend yield with the information on all these other metrics before. A lot of companies may offer a 10% or even 15% dividend. However, they may not have a track record of paying it often and may cut the dividend at the first sign of trouble. Likewise, a very high dividend yield can also show us that a company is compensating shareholders because they're taking on a very high amount of risk. So even though you're getting a very nice return from dividends, you could potentially be losing the capital value of your investment in the first place because of how much risk this company has taken. So I ask you, what do you prefer? Do you prefer a company that gives you maybe 12% dividend right now, but could perhaps cut it in the near future if they see any turmoil? Or do you prefer a smaller dividend of 5% perhaps? However, the company has a proven track record of consistently increasing the dividend and consistently paying no matter what. For some, the risk is worth it. However, it always has to be paired with a delicate analysis of every single dividend stock you're considering buying. Remember, even though I mentioned a few really important metrics and ratios, this is not an exhaustive list, and you should really just do your own research and find which metrics and ratios you like the most and invest based on that. Now I want you to tell me, which metrics do you like looking at the most, and which dividend stocks are you considering buying right now? I will respond to every single comment down below, so I really want to hear what you have to say. So thank you for watching this video, and I'll see you on the next one.